Dylan, welcome to the show.
Stephan, thanks for having me, man. Long time listener of the show. A lot of content in this space, so I can't say I've hit everyone, but I've definitely listened to a lot of the technical episodes, and it's helped me out a lot. So it's quite cool being on here.
Yeah, for sure, and I'm a fan of your work. I've seen you've really come up in the last year or two. You've been putting a lot of good quality material out there, and I know there is this theme that has come across. Obviously, you're known for a few things, right? You talk about on-chain analytics as well as writing in the space, research. But I've also seen you talk about the use of debt as well. So I think that's really interesting and an interesting theme. But maybe just first for anyone who hasn't heard of your work, maybe they're new. Tell us a little bit about yourself, like how you got into this Bitcoin stuff and what your focus has been.
Yeah, so right now I work with Bitcoin Magazine. I'm head of market research there. So Bitcoin Magazine has a like a premium markets product. So we put out kind of Bitcoin and just like generally like financial market research on a daily basis. It's called the Deep Dive, and so there's free and paid tiers there. But we just kind of look at what's happening on chain, look at what's happening kind of with derivatives, and keep readers informed. But really, we could try to paint it all with a 10-year, or actually probably longer than 10-year, like this hyper Bitcoinization theme. Bitcoin is the best money, the best monetary asset the world's ever seen, and so we're just kind of documenting that journey with data. And so that's kind of my day to day in terms of how I got into Bitcoin. I was really just kind of stumbled upon this thing that grabbed my attention in the later years of high school and my freshman year of college. Studying business in college, decided it was not worth the value that I was paying in, so I dropped out and just said I'd try to figure out this Bitcoin thing and worked a job in the meantime. But long story short, kind of stumbled into a role at Bitcoin Magazine, and carried me here ever since. So really grateful and kind of I mean really grateful to kind of come along this journey, and it's pretty cool because Bitcoin is just kind of this arena of ideas. And for me, someone with no credentials, it doesn't matter because it's more about just like the merit of your ideas and then what you're putting out there.
Absolutely. And I think that's really testament to the quality of the dialogue in the Bitcoin space, that it's not really about like, oh, what university did you go to? And it's not about that at all. It's really just about like, what is the quality and the value that you're bringing for listeners or readers or consumers of whatever material you're putting out there. And I definitely see you as a bit of a rising star in the movement, as it were. So that's cool to see. And I know, so yeah, we were chatting about this idea of using debt in the Bitcoin world. And I know this is something you've spoken about, and I guess it can seem like a bit of a taboo, right? Because the way most of us were raised is like, oh, debt is bad. You should save. You should not have too much debt. Or if people are used to looking at the typical, let's say, if they pick up a personal finance book, they might read Dave Ramsey or someone like that. So can you tell us a little bit, how do you see the landscape of it? Set the scene for us. What is life like under the fiat standard, or at least up until recent years?
Yeah, so I mean, I think just when you're looking at kind of how the fiat monetary system works, we moved away from the gold standard, and we Bitcoiners have talked about that quite a bit. But with fiat money, every dollar that's in circulation was created through credit extension. It was lent into existence by a commercial bank. So debt is kind of a necessity in this world that we live in, regardless of if you choose to take on any debt, which depending on the circumstances, and for the last 40 years, those circumstances have been ripe. Taking on debt is in your favor if you use it wisely. Obviously, six figures, 100,000, 200,000 student debt may not be the most prudent thing, but the richest people in the world never sell their assets and just continue to use debt to their advantage to get richer under this fiat monetary system. But I think one of the important things to understand with debt and just kind of I guess investing in general is understanding a balance sheet and understanding the asset and liability side of a balance sheet. A lot of people. I first kind of had this aha moment when I read Pierre Richard's speculative attack piece, which he wrote in 2014, which is really kind of mind blowing. I encourage everyone to go read it. It's on the Nakamoto Institute. It's a great website. A lot of gold in there, just in terms of timeless content. But really, anybody that holds Bitcoin, anybody that has even some Bitcoin on exchange, Bitcoin in cold storage. Even I'd go as far as saying just any sort of Bitcoin exposure, right? I mean, I would obviously say hold your own keys, stack sats to cold storage, but even something like a exposure to GBTC or anything of the like, if you have any sort of Bitcoin exposure and on the asset side of your personal balance sheet or company balance sheet or whatever it is, and you also have liabilities, you have debt, you have loans outstanding that you haven't paid. Well, by definition, you are somewhat of a leveraged Bitcoin investor, a leveraged Bitcoin holder, because you acquired that Bitcoin and didn't pay, and the other choice was paying off that debt, and you chose not to. So whether that's credit card debt, a mortgage, anything, you decided to forego paying that to acquire Bitcoin. And so over the last 10 years, Bitcoin has been the best performing asset ever. The compound annual growth rate conservatively is just, we'll say 100%. It's somewhere in those lines. If you go from the first time Bitcoin had a market price, it's like 200% compounded annually, but no one really saw those returns. But regardless, a lot of people will say, don't take on debt to buy Bitcoin, without really understanding that if you have any sort of liability, if you have any sort of loans outstanding, and you have Bitcoin on your asset side of your balance sheet, well, you are essentially borrowing to buy Bitcoin. And so your hurdle rate is whatever that interest rate is you're paying on that debt is. For some people on a credit card, it's 15%. And I'm not saying go do that, but if it's a personal loan at 8% or a mortgage at 3%, you are not paying that interest. That interest is compounding, and the opportunity cost is you acquired some Bitcoin. And so a lot of people are doing this without even really realizing it. And it's been, Michael Saylor is doing it at an institutional scale, but these are the things that you have to kind of consider as we're going towards this new monetary standard.
Yeah, really interesting. And so that definitely echoes the point that Pierre made in Speculative Attack, as you rightly pointed out, that even if you have some debt, to some extent, if you think about your balance sheet, you are, in some sense, leave it, or you at least made a choice. And you could have paid off that debt, but instead you're purchasing Bitcoin, or you're levering, in some sense, to buy Bitcoin. Now, I guess it's important and prudent to say there are degenerate ways to do this, and there are conservative, or at least more conservative ways to do this, right? So obviously people go to, pick the random shitcoin casino of choice. People can lever up. That's also levering up on Bitcoin. But there are other ways as well that you can go into debt. And for example, there's a difference between the types of debt. So for example, with some of the loans that you might get out of your Fiat bank, it's not like they are going to reclaim your Bitcoin. It might be an unsecured loan, or it could be secured by something else. Like, so for example, you can have a car loan secured by the car. You can have a home loan secured by the home. And so there are other ways to access credit. It's not necessarily going to the shitcoin casinos and doing leverage trading on that, right?
Yeah, of course. I think that's a great distinction to make. There's all these derivative exchanges around the world, where you can essentially speculate on the price of Bitcoin going up or down. But if we're talking about, borrowing against your Bitcoin, going 2x levered long on a perpetual swap contract, I mean, essentially you're borrowing against your Bitcoin. A lot of, because you're not actually, getting a loan from a bank and applying, it may not feel like that, but it's the same thing. But I think the most important thing to understand when you're talking about leverage and increasing your Bitcoin holdings is you never ever want to become a forced seller. That's the worst thing that can happen to you as someone that's looking to accumulate Bitcoin. And so if we're talking about Michael Saylor, right? A lot of Michael Saylor, he got a little bit of heat in April when he was like, take on mortgage the house, buy Bitcoin, blah blah blah, buy Bitcoin, and he got a lot of heat. And he was doing it at an institutional scale. With billions of dollars, but I think the thing to understand is, Michael Saylor, he took out $500 million and a junk bond raise at 6%. But that principal is paid off in 6 or 7 years, and he's just paying a 6% coupon on that debt. So the break-even price for when he purchased Bitcoin at, I think it was $37,000. The break-even price in 2027 is like $6K. Is like $60K. And so this is something that he's not going levered long on BitMEX. And so the worst thing you could possibly ever do with Bitcoin is put yourself in a position where you have to sell and you don't want to. And so I think that's just a really important distinction. Unsecured debt, there's still ways to acquire leverage, acquire capital in a fiat standard without putting your Bitcoin holdings at risk.
Of course, yeah. And I think the other thing people are probably thinking about, and again, it turns into what monetary system are we living under? Because if you talk to, let's say, our grandparents, someone at that age, they're the way they would think about it or would have talked about it is, oh no, don't go into debt. It's, you should be prudent, you should save up, you shouldn't be levering up. And yet, as you rightly point out, in the fiat financial system today, it rewards people who take out this debt early, right? And so even listeners, if you've seen the work of Guido Hulsmann, he talks about this. He says even new graduates coming out of university, what's their incentive? It's to borrow. And the example he uses is to borrow and buy a house. And because he knows that over time, that the value of that loan in real terms is coming down over time. And typically, the typical person who starts a new job is getting promotions over that time period. So that's just the incentive. It's just that people have an incentive to go into debt, to borrow, to buy things that they want, or in this case, to buy Bitcoin. So I'm curious, do you have any thoughts to add on that, or should we get into maybe what it looks like in practice for people who are doing this?
Yeah, I guess I just, the one thing I'd preface with this whole conversation is that we're truly living in unprecedented times. Historically, we've seen periods of basically negative real yields, right? So interest rates, Fed fund rate, global central banks around the world are pegging interest rates at 0% because debt burdens are so high that people wouldn't be able to service, basically everybody in the economy wouldn't be able to service their debts. And essentially, like, everything would collapse if rates weren't this low. And so, right, if you have a 3% loan, well, inflation, according to the official government statistic, is 6%. I think everybody kind of understands it's a lot higher than that. So your borrowing cost, your interest rate, your hurdle rate, in real terms now, today, and really for the last decade, I think if you're looking at it in terms of what inflation actually is, maybe broad money supply M2, and not CPI, inflation or yields are really negative. And so I think that's an important thing to understand here, is that we've been in a secular downtrend since 1981 globally with interest rates. And now debt burdens are so high that central banks, governments are trying to erode the real value of these debt burdens, and they're trying to do it by running inflation hot. And so I think, when we're talking about borrowing money to buy very volatile asset like Bitcoin in BTC USD terms, long term, we understand that the purchasing power is going up and to the right, but there is trading volatility, that's for sure, or really just any other asset. We're prefacing it with saying we're in a time where real yields are as negative as they've been in basically anybody's lifetime.
Absolutely. And so it's just operating in this weird environment where inflation, and it's like this concept of the iceberg, right? Like the amount that you see above the water is this amount, but actually the amount you see below the water is like really big. It's like way bigger. And so what we should have seen theoretically in a real free market is that we would have this growth deflation. The cost of things is coming down over time, but yet we're actually seeing the cost of things go up over time. So it's like that amount below the water is that unseen benefit that we should have had, right? And so it all comes back to that point around how much inflation there really is, because that 6.1% is just the amount above the water. We're not even counting all that the iceberg below the water part. So It really is just a lot of inflation that we are living through. And so that's why I think people who are switched on, people who have a fundamental thesis about what they view Bitcoin is, it's going to become the money of the world. That's the thesis, essentially. And under that sort of condition, we anticipate the price of Bitcoin to rise over the long term. And that is where this idea of either borrowing against some Bitcoin or taking out a fiat loan to purchase more Bitcoin on the basis that your cost of interest is less than the cost than the amount that Bitcoin is rising every year, aka CAGR, compound annual growth rate. What do you think?
Exactly.
Fair summary?
Fair summary. Great summary.
Yeah. Okay, so let's talk a little bit about how this might work and what kinds of interest rates are available, and maybe we can sort of spell it out a little bit. Like, let's say we're just a retail pleb versus kind of the rates that are available to people who are maybe higher up or have more capital available.
Yeah, so I mean, there's obviously a spectrum. Does someone have assets or not? I think the crazy thing is in 2021 we've kind of reached this threshold, this financialization of Bitcoin, and that sounds like a bad word. It's not. It should be welcomed. Where if someone has a significant amount of Bitcoin holdings, similar to if someone has this family has a huge real estate portfolio, you really never have to sell. And that wasn't true for much of Bitcoin's history, but now it is, in the sense that if you have millions and millions, or whatever that number is for you, or your business or your family, where you're comfortable, and probably an order of magnitude more than where you're comfortable, you can just simply borrow against your Bitcoin, 1% of your holdings, and live off it very comfortably. And when that interest comes time to be repaid, you borrow against it again. Obviously, that's not the case for everybody. We're going from the retail pleb, right? So you're stacking sats. You're trying to acquire as much of this hard money as you possibly can. I think the important thing to think about if you're looking at any sort of debt, credit score is still obviously really important in this world we live in this fiat world. What's your cost of capital? What can you access? If you've been paying your mortgage for 30 years and you can pull and you can borrow at 2% or 3%, that's a fantastic deal. And I think it's definitely something to consider. One of the things that is really important to also consider is are you able to cover basically these interest payments? Is your disposable income enough to cover basically to cover this debt without having, again, to become a forced seller of the thing you're trying to acquire, which is Bitcoin, because there is volatility risk, right? So that's something where, if I'm borrowing even at rates that sound really high, like 10%, if Bitcoin draws down 50%, am I going to be okay for the next year or two or three, being basically like on paper underwater, right? That's something to definitely consider. So there's obviously like personal loans. Not recommending this, but even a credit card at 15%, if you're just spending your day to day versus and stacking a little bit more to your cold storage, that's something that has worked for people if they've done it throughout time. Then again, we have the collateralized Bitcoin, which I will go out and say I've looked into a lot of these options, and I think Bitcoin as collateral will become basically the cheapest borrow rate you could possibly find anywhere in the financial system, right? Because you have a mortgage, which is basically like your home equity line of credit. Your bank extends you some credit, and it's secured by the house. That's basically the lowest rate you can get. And maybe it's some private Goldman Sachs brokerage's account, you can get Fed funds plus 50 basis points or 75 basis points. But for the most part, the home collateral is the most accessible for the average person, and most people have, if they have a mortgage, maybe have some equity in there. But Bitcoin as collateral compared to a house is orders of magnitude better, and for lenders, I think they're just starting to figure this out, right? Bitcoin is fungible, liquid, 24/7, 365 in every jurisdiction on the planet. And the volatility, yes, your house isn't going to draw down 80%. Bitcoin might, and it might do it in a week. I'm not saying I predict that, but it's happened before. But with Bitcoin, you can over collateralize, and so really for lenders, I think you're just starting to see lenders wake up and realize, oh my God, this is a no risk, this is a no loss business when I'm lending against over collateralized Bitcoin. And so I think because of this reality, I think Bitcoin collateralized loans become the lowest, basically like the lowest rate you can find anywhere in the world. Then you're not going to need a credit score to get that. But it's important to kind of preface it with saying, you probably shouldn't do this with your whole stack, because worst case scenario is you always want to be able to lower that loan to value ratio. You always want to be able to over collateralize if the exchange rate BTC USD goes down, because all of this, the ability to kind of borrow against your Bitcoin forever, there's a big assumption there, and the assumption is that the Bitcoin price goes up, which we kind of know is a mathematical certainty or inevitability, and that may sound irresponsible, but just kind of understanding the fiat system, understanding the monetization of Bitcoin, that's the long term game. But the short term, there's a lot of uncertainty. So like whenever we're talking about this, there is risk, but we're talking, you want to be able to mitigate those risks, and doing any of these strategies with a large part or all of your stack, it puts you in a position where you really can't mitigate anything.
Right. And I think psychologically, the risk as well is just too great that it's one thing to have a high percentage of your net worth in Bitcoin, but then it's another to actually lever up even on top of that and place yourself at a significant risk versus if you were, let's say, conservatively using debt to stack. And so I think there's a few points I wanted to make as well. One point is that it doesn't necessarily mean everyone has to go out and get loans to buy more Bitcoin. It could just mean that you understand the fiat system and use it in some sense in your favor. So as an example, you might already have a home loan and you might already have a very low interest rate on that. And so whereas some people have this mindset of, I need to pay it down as quickly as possible. Instead, if you strategically pay the minimum on your home loan for your house and then use the rest to stack sats, well, that's an example that's like relatively conservative, right? Like you're not actually going into debt to buy Bitcoin. It's just that you are strategically paying the least on your home loan because you're realizing, hey, the value of this loan is going down over time in real terms. So I'm best off paying the minimum there so that I can stack the max number of sats. That's one example, right?
It's a fantastic point. Yeah. And that was what I was trying to communicate with, it's at the beginning with, the asset and liability side of your balance sheet. Everything's a trade-off. And so, obviously, like if you have liabilities and you have these payments due, pay them. But that principle that you may pay off because Dave Ramsey said so, because it's the conservative thing to do and the right thing to do. Well, are you going to pay that down for your house that's going up by 5 or 10% a year, or are you going to acquire Bitcoin into your cold storage that's going to go up by whatever it does over the next decade? Well, probably an order of magnitude more too than your house. And so I think that's a great point to make, and it may not be the most obvious for many.
Right, because I think for people who have not had accounting and finance training, they're not going to necessarily be thinking in those terms. They might have just thought in the simple, just pay it down as quickly as possible. Or sometimes you might, and in fairness, this is a psychological thing, you might psychologically feel bad about having debt. And so the idea is, I want to get rid of debt as quickly as possible. But at the same time, we are potentially leaving some sats on the table there if we do that, because it means it's sats foregone. You could have purchased sats. And so that's important to think about also. So let's talk a little bit about this idea of, this idea, and I've heard, this has become a popular thing recently with some articles talking and popularizing this idea of buy, borrow, die, right? It's like this idea that rich people, and as you mentioned earlier, I'm sure you're familiar with this idea, is this idea that rich people don't necessarily sell their assets, they just borrow against them. Whether that is stock portfolio, whether that is their property portfolio, whether they're a tech billionaire and they have stock in their own company and they just put some stocks up against to borrow that to use for day-to-day fiat spending. And so I guess there are different ways to think about this, right? So as an example, you could think of it like, okay, I've got some coin. So I guess where we're going with this is there's different purposes of using the debt. So I guess high level, let me kind of spell out 3 examples and maybe you can just add whatever you're thinking on it as well. So one is just stacking more sats, right? You just want to be able to essentially lever up. Number 2 is you might want to, for example, set up a Bitcoin mining operation. And so instead of paying sats to buy Bitcoin mining equipment, you could use a loan and use borrowed fiat to fund that Bitcoin mining operation, which might be more optimal. And then 3 is you might be living off your stack, right? This is buy, borrow, die, that you are trying to parallel what rich people are doing, that let's say maybe you're at an advanced stage of your own life, 60s, 70s, 80s, and you're thinking, okay, I've accumulated and now I want to be able to live off that stack. So that's a few examples. Do you have anything you wanted to add to that or around those purposes of using debt?
Yeah, I think specifically we're seeing a lot of mining is extremely lucrative right now. Since last summer, the Bitcoin prices has gone up 5 or 6x, and then hash rate has increased, but it hasn't followed. So you're seeing like hash price, which is miner revenue divided by hash rate. That's essentially how profitable a marginal unit of hash is for miners per dollar. That's gone up 3 or 4x in the last what is it, 15, 18 months. And so mining, basically, you can plug in any machine over the last 3 or 4 years, and you're depending on your power source, obviously, you're deep in the money. And so mining, sorry about that, mining is extremely lucrative right now. And so you're seeing a lot of people say, hey, I want to get into the mining business without maybe the expertise, or, you have companies, hosting companies like, say, Compass and a lot of these other companies, not saying these are good or bad investments, just listing them off. And a lot of people, because Bitcoin mining, say, hey, maybe I should sell some Bitcoin. Um, the things to consider, and there's a lot of variables here. Is what's you're gonna break even on your dollar amount most likely, probably within 12 months with what hash price is looking like and just how large these margins are for Bitcoin mining. With the thing to consider though, and what you really have to evaluate if you're looking at mining in particular, is that essentially you're basically guaranteed with Bitcoin mining and kind of the game theory and what hash rate's going to do. Hash rate's going to rise forever, and your Satoshi revenue is essentially going to fall. Is basically going to be guaranteed to fall for forever. With difficulty continuing to ratchet up with the halving in 2024. So it's not very optimal depending on where you are in the cycle. Sometimes it is. It's a great time to sell some Bitcoin for miners, but a lot of people get burned by doing it. So it's pretty optimal if you can say, hey, I'm just going to borrow against 3-5% of my stack, and I'm going to buy some ASICs. And that rate is what, 5-6%, maybe 3%, maybe 8%. But that's a different story. And so purchasing ASICs and plugging them in and having those churn out dollar revenue and Satoshi revenue, when your cost of capital, when your hurdle rate is not Bitcoin, it's not BTC, it's 5-6%, annualized in dollar terms. That's doable. And so I think that's something that you're seeing happening on an individual basis, at the pleb level, and you're also seeing this at an institutional level. You're seeing Marathon, Hut, these huge publicly traded miners. They're going up to, one of them is a Federal Reserve Bank, a member bank, Silvergate in California. They actually have access to the Fed window, and Marathon has $100 million collateralized rolling line of credit with them. And so that's kind of exciting, right? Like, obviously, the big miners, and sometimes they're not the most loved by the plebs because, there may be regulatory risks and et cetera. We could go down that path, but the exciting thing is, these huge miners that are mining hundreds of Bitcoin every quarter. They're, I think, 1 exahash, 2 exahash of hash rate. They don't have to sell, and their margins are so large that they want to go buy 10,000 more ASICs. Well, they're just going to borrow against a little bit of their Bitcoin, and so this has kind of changed the game for a lot of these publicly traded companies. It's changed the game for some plebs, and I think just the amount of basically services that will allow you to do this in a way that's optimal for Bitcoiners, in the sense that you understand the counterparty risk, which is there. It's always there. If it's not in your own custody, the Bitcoin, if you don't have it with your own seed phrase in your own cold storage in your own custody, well, there is some sort of counterparty risk, and that's kind of hard to quantify at times. But with services like Unchained, which says, hey, we'll put this in a multisig, and we'll put this and we'll leave it transparently in this address, and as long as you pay it down, it'll stay there. That's pretty optimal. And so I think hopefully we see kind of more transparency, more services, more options get built out where it's very easy to just kind of tap into this. You're seeing this with kind of other chains. You see the rise of DeFi where there's these liquidity pools, right? Obviously, there's protocol risk. There's other risks in these chains like Ethereum, and you're using wrapped Bitcoin, and there's protocol risks on all these alt chains. But it's just a start, and I think you're going to see a lot of these things that are being built out and kind of built fast and breaking and just kind of trial and error on these other parts of the, if you want to call it, crypto ecosystem. I think that's all going to slowly be built out on a really sturdy foundation in the Bitcoin world, and I think that's one of the most exciting things we'll see over the next decade.
Right. And the existence of these markets, whether they are the likes of Unchained Capital. Now, disclosure for my listeners, Unchained Capital are a sponsor of my show, as are Compass Mining. And so this might help people to not have to sell their coins. So I guess that is coming into that purpose of, let's say you're trying to live off your stack. That's one example. Or you want to participate in this kind of more permissionless finance world. Maybe another example would be HODL HODL, right? So that's also another one where you can collateralize Bitcoin and borrow stablecoins, as an example.
Yep.
Liquid USDT, USD Tether on Liquid blockchain, sidechain. So that's another example. So I guess let's just talk through the continuity part of it. So let's say you start that loan, and let's say now it's been a year or 2 years, that loan is coming to term. What does it look like? So maybe we could talk through an example just to give people an idea. What does it look like to roll over that loan and sort of sustain this idea? Because let me just kind of frame it in one way. So let's say there's some big life purchase item that you want, or you want to do Bitcoin mining as an example, or you want to lever up on Bitcoin. The idea is, instead of selling, I don't know, just to pick numbers, instead of selling 1 Bitcoin today to get that, you're selling, 0.1 Bitcoin in 4 years' time or something like that, right? That's an example of how, by using the fiat system, people are able to lower the amount of sats that they are selling or foregoing, right?
Yeah, so that's a great point. And I think, everyone needs to have a strategy in terms of how they think about this. What is, what's the area where they start to think, hey, maybe I should start to cover some of this principal. Maybe it's time, depending on what you're looking like, maybe it's time to over collateralize some more. I think so. Just like, I guess, to give an example, right? Say this summer you have a large stack of Bitcoin. You have all this pristine collateral, and you're basically living on zero fiat. So Bitcoin goes to 30K. It's down from 60. You have a disposable income. You have a salary. Just if we're talking about the average pleb. When you want to stack some more Bitcoin because it just went to 30K, you're feeling really bullish, everyone's bearish. And so you over collateralize 10% of your stack. Say it's, just throwing out numbers, say you put 2 Bitcoin in as collateral, you get $30,000 of USD, and you buy another Bitcoin. And so now you have that Bitcoin locked in as collateral, that 2 Bitcoin, you acquire another one at 30,000. And now, as the cycle progresses, Bitcoin starts to appreciate pretty significantly. We're sitting here at around 60,000. Well, if say we get to 100,000, 150,000 in early 2022. Well, now it's time. I think a lot of people, especially with the euphoria that comes with Bitcoin all-time highs. I mean, when you kind of are all in financially, maybe career-wise, maybe just like in many senses of the word, a lot of Bitcoiners are very, very passionate. It can get kind of overwhelming in the best way when Bitcoin is ripping, all-time highs. Everybody's talking about it. There's a huge buzz in the media and the financial world, and kind of your human monkey brain may say lever up more, But what really the prudent thing to do here is you've been stacking sats the whole time. Well, when Bitcoin appreciates by 100%, 200%, 500%, whatever you kind of quantify as being, hey, maybe I should take some risk off. The best thing to do is essentially, and it sounds kind of counterintuitive, is to stack some fiat. So say instead of continuing to stack 110% of your disposable income into Bitcoin, if Bitcoin appreciates by 500% since the time you took some collateral out, well, maybe it's a pretty good time to basically pay down a little bit of that principal, is to reduce your overall leverage. I think, like, personally, and I've been pretty transparent about this, my strategy over the next decade is essentially like my bear market strategy, and I'm looking at all this data. my bearish Bitcoin scenario is essentially I have 100% of my net worth in Bitcoin, and my bullish Bitcoin scenario is I have 105%, 110%, 100. Like I never want to be essentially like 2x levered long, because Bitcoin goes down 50% and essentially your net worth is a zero. And not that I'm gonna have all of this in some liquidation engine that can just wipe it all out at once, but I'm pretty comfortable just riding with a stack of Bitcoin and not caring about the exchange rate. When it becomes optimal to do so, acquiring a little bit of leverage, whether that's with Bitcoin collateral, whether that's unsecured in the fiat world, and acquiring a little more of that Bitcoin. And as Bitcoin appreciates, anytime Bitcoin draws down 40-50%, I think you could call it the sailor strategy, right? Michael Saylor isn't going to, when Bitcoin goes to 150,000, Michael Saylor isn't going to go borrow another 2 billion to buy. He might start paying down a little bit of that principal, though, or he might start paying down a little bit of that $1 billion he borrowed. And essentially, if you're thinking of that trade in dollar terms, it's a huge win. He acquired some Bitcoin using fiat debt. The hurdle rate is 5 or 6%. Bitcoin appreciates by 500%, and he starts paying down that principal. And so that's a brilliant carry trade. And I think that's how people should start thinking about it. Bitcoin breaks an all-time high. May not be the best time to go lever up, but Bitcoin's going to draw down another 50% at some point. It's going to happen. And so that may be the point where, from a risk reward standpoint, you take out a collateralized loan with a small portion of your stack for with a 25% LTV. Bitcoin has to draw down 75% before you get margin called, and it's already gone down 50%. And you have some more collateral. Like, I'm just throwing out ideas, and I'm rambling a little bit here.
Yeah, no. I think this is, yes, good. And I think one point I'd love you to expand a little bit is how people can think about their margin call points or their liquidation points, because that's probably something to think about as well. Like, it's prudent to think about, okay, if I'm taking this loan at 30,000 or whatever amount, how much does it have to go down before I get liquidated based on how much collateral I'm putting in? So as an example, maybe the minimum on the platform might be 200% collateral or 250% collateral, but you might say, no, I want to be even more safe. I'm going to go for 300 or 400% collateralized. Maybe if you could explain a little bit around how to think about that and how to, basically how to think about your liquidation points.
Yeah, so if you're thinking about just over collateralized Bitcoin lending, because we're talking about this being a no loss business for lenders, right? Bitcoin is a very volatile asset, and the financialization of Bitcoin is being able to get credit off of it. This wasn't always the reality for throughout Bitcoin's history. This is somewhat of a recent phenomenon. The regulatory environment has improved and warmed up to Bitcoin, and more importantly, big money is saying, hey, this pristine monetary asset, we're seeing all these derivative exchanges, the shitcoin casinos essentially, Arthur Hayes and creating the BitMEX perpetual swap, and all of these essentially these synthetic derivative markets on top of Bitcoin, on top of these native crypto assets, and the big money is saying, hey, we want a portion of the pie. And so now we're seeing these lending markets emerge, and so you're seeing platforms like BlockFi, and I think you're going to see every commercial bank. They're partnering with NYDIG. I would be very, very surprised if in 2 or 3 years, and I'm not going to use them, but if Bank of America doesn't have a collateralized Bitcoin lending service. And so there's a bunch of different options, and I think this will be completely variable and up to the consumer in the coming years, basically across the board. You're going to say, hey, I want to borrow at an 8% rate, and they'll say, okay, you need to be 2-to-1 collateralized, so a 50% LTV. And so essentially, with if you give me $2,000 of Bitcoin, I'll extend you $1,000 of fiat liquidity. But if Bitcoin draws down 50%, we're going to have to take that collateral from you, and we're going to basically margin call you. And so depending on your risk tolerance, depending on where the Bitcoin price is, you may say, hey, I don't want that that chance of getting margin called with a 50% drawdown. That happened in March 12th, 2020 in 4 hours or whatever it was on that crazy day. And so, hey, maybe I want to be 3-to-1. So 3-to-1 over collateralized and be a 33% LTV. And so Bitcoin has to draw down by 66% to get margin called. It can be 4-1, 5-1 over collateralized. And I think it's important to understand that even if you're doing this very over collateralized, it's still you shouldn't do this with a super majority or all of your stack. You should do this with something where if that margin call is close to happening, you can always over collateralize further. That's the really important thing here is you never want to put yourself in a position to lose everything. You never want to be a forced seller. Like this whole conversation we're having is the whole thing is never be a forced seller of your Bitcoin because tax purposes and you just don't want to give up this pristine asset. That's the whole game here. But if you want to say borrow at a 3-to-1 LTV or 33% loan to value ratio with a say 66% drawdown, well, that's pretty conservative. So if Bitcoin has already drawn down 20%, 30%, 40% from the all-time highs, doing something like that could be, in a risk reward sense, pretty attractive. And so that's how I kind of think about it for the next decade. As long as a fiat exchange rate exists, I tell people, I say, hey, I don't think the dollar is long term is very I don't think long term the outlook is very good. But as a Bitcoin accumulator, I really hope the dollar doesn't dissolve tomorrow, and it won't. The dollar won't go away tomorrow or next year or even 5 years from now. And I don't think it will go away 10 years from now just because of how long dated a lot of these liabilities are. But I hope that this BTC USD exchange rate persists for a long, long, long time because it's pretty advantageous for Bitcoin holders and holders of this pristine collateral as long as this funny money Federal Reserve fiat monetary system exists because all of these interest rates are fake. And so the financialization of Bitcoin in a sense, and the reason that I find it so fascinating, and I follow a lot of the stuff happening in the Bitcoin derivative markets and the Bitcoin futures markets and all this stuff, is because it's almost this parallel system, this parallel cost of capital that's calling the bluff on the incumbent system and saying, hey, these interest rates, they're not real. Like if you want to sell, for instance, Stephan, and this is a little bit of a tangent and a little bit a kind of a side note, but it is all kind of interrelated, I think, is in the Bitcoin futures market, there's similar to gold futures, similar to, any other commodity, you can basically promise to deliver Bitcoin in, say, March of 2022. And I'll lock in Bitcoin in escrow and I can sell you this futures contract. Well, that price isn't trading at the price it's trading at today. Is trading at, say, I don't know, 60,000 or 61,000. And so there's a 10 or 15% annualized premium on that Bitcoin. And so in the Bitcoin markets, in the crypto markets more broadly, the cost of capital isn't 0%. It's not 1 or 2%. It's not 3%. Depending, and it's very variable, and it's very variable depending on sentiment, depending on leverage. But most of the time, this cost of capital, this risk-free rate, like I can just capture this delta neutral, market neutral in these futures markets is like 10, 15, 20%. And so here you have billions and billions and billions of dollars in these futures markets, in these derivative markets, in these lending markets. All of these things, whenever you see a stable coin, with an 8% yield offered on some of these exchanges, and they're saying, how are they coming up with these rates? And they're saying, that's definitely a Ponzi. How are these exchanges doing it? Well, it's because the cost of capital in these crypto markets, in these Bitcoin markets, again, with billions of dollars of liquid trading every single day, that annualized cost of capital is like 15, 20%. And so that's where it's really interesting and that arbitrage exists is because the people in these markets kind of understand that the fiat rate is kind of not real, right? And so that's where this is really exciting, and this arbitrage exists as these worlds kind of converge and collide. Is that the fiat world, the commercial banks, everybody that's going to enter this space that is going to offer Bitcoin collateralized products and all of this over the next 1 year, 5 years, 10 years, they're still operating on a USD standard. And there's people like us that are saying, no, it's a Bitcoin standard. And if you're offering me a 5% annualized rate to borrow money, I'm going to take that all day. And I'm going to do it in a risk responsible way. But, we can use that to our advantage.
Right. Yeah, I think you put it really well there. And so we can take an educated guess or speculate a little bit. about the kinds of products that will become available over the next few years. So, for example, and this is probably not a big novel idea, but people in the Bitcoin community are saying this. For example, this idea of having a credit card that you could collateralize with Bitcoin, and you could borrow and use that for your living, your day-to-day, paying your expenses. So that way you're not spending sats. And so it helps people essentially attack the fiat system, taking loans every time they're spending on their credit card, and just having some Bitcoin as collateral and just sort of relying on that. Or another idea might be the idea of having like a home loan product that you can collateralize again with Bitcoin. So I think these are some of the ideas and directions that we will see. And as you rightly said, some of the big banks, they might start. So as an example, even in Australia, the Commonwealth Bank of Australia, the biggest bank in Australia, recently came out saying you can buy Bitcoin inside the app. It would only be natural for them to sort of, in a few years, who knows, take that next step and say, hey, we'll let you collateralize that, because now you're going to be paying us interest. So everyone's getting their own little piece of the pie here, because the banks are getting interest revenue. You and I, the hodlers, are able to keep hodling, right? So basically these products help us keep hodling. That's an interesting way to summarize it, perhaps.
Yeah, exactly. I mean, and a lot of these banks, like the legacy incumbents, the guys that have trashed on Bitcoin for the last decade, like it's not that they want to see their eventually see their business get destroyed because Bitcoin kind of obsoletes them. It's that it's a no-brainer, and it's like competitively they in a game theoretic way they have to enter these markets because again they're lending money, they're lending and their risk-free rate is set at 0% and inflation's running hot, and they're lending out rates to personal loans or corporate lenders or corporate borrowers at 3%, 5%, and they see on the other side, they see people are borrowing against their Bitcoin completely over collateralized. So to highlight again, for lenders, it's a no loss business. Yes, there is some, I guess there is some execution risk, maybe depending some liquidity risk when Bitcoin has these, huge liquidation events like we've seen in the past. But really, if you're doing it right, it's a no loss business for lenders. And so they're saying, oh my God, it's a no loss business, and they're still getting this pretty attractive interest rate. Well, it's a no brainer. And so that's why they're all coming, right? It's not like they want to just obsolete themselves. It's because they're seeing others do it, and there's a huge demand for doing this with this basically newly found $1 trillion asset class, right? Like there's an immense amount of wealth from Bitcoin holders, and those Bitcoiners like don't really have an interest in selling, right? If you have a large stack of Bitcoin over basically today, you have gone through a lot to get to this point, and you now with Bitcoin at 60,000 and the legacy system looking basically as shaky as ever, you're gonna say, yeah, I'll just sell all of my Bitcoin, or I'm gonna sell a large part of my Bitcoin. No, that's not what's gonna happen. You just want to like you understand the end game here, and so that's where this is really exciting, is because and to highlight again, to go back to kind of that speculative attack article, the thing that people don't really understand is that when dollars are lent, when a loan is extended, fiat money is created. so you have this absolutely scarce monetary asset, Bitcoin, 21 million, against this fiat monetary system that with every dollar that's lent out, the money supply expands. If I'm a lender, if I'm a commercial bank, I fractionally lend out my reserves. I have an asset plus this interest payment that I'm expecting. You have a liability and you have the dollars in your hand. That just created money. And so this speculative attack, whether it's me going out there and getting a 0% credit card for 12 months and just spending it on my grocery bill and stacking sats with the difference, or it's Michael Saylor executing this on a $1 billion scale, we're actually introducing more fiat units into the system while hoarding the Bitcoin supply to ourselves. And so this actually exacerbates the process of hyper-Bitcoinization, and it's kind of this feedback loop that basically kind of guarantees the demise of fiat, which is this kind of big brain idea, but it's pretty exciting to see it kind of play out across the world. It's pretty fascinating.
Right, yeah. And so it's also fair to say that this principle or idea existed even just in the fiat world, with people borrowing to do property purchases or stock purchases or other ways where they're levering up. But I guess the difference here is Bitcoin is actually a viable new monetary standard, whereas property and stocks could not become money. They're not marketable or saleable in the way that Bitcoin is. So that's an interesting aspect there. Now, I don't want to be too much of a negative Nancy, but I think it is fair to point out some of the risks for people, right? I think listeners of my show are intelligent, I think, but just to make it clear for everybody that there are risks, this is not a free lunch, right? So you are paying interest. That's one thing. Yes. You're paying an interest revenue for the loan, obviously. There is a liquidation risk, as we've spoken about, right? So Bitcoin has gone through multiple 80% drawdowns, and there's no guarantees that it won't happen again. And it can happen very quickly. So at that time, for example, in the March 2020 example, it can happen very quickly. And you might not have that time to get your collateral in. So as an example, instead of getting liquidated, if you have the option to put some more post more collateral, to post some more Bitcoin, but guess what? During the price drop, the miners have an incentive to, well, basically the blocks slow down because the price is lower. Miners have less of an incentive. So, and then feed rates go up. So now you're actually trying to get your Bitcoin into the collateral at the precise worst possible time. So that's an example there. Also, not your keys, not your coins. So that's always something people have to think about too, because if you're using a provider and you do not have a quorum of keys, even if you hold 1 out of 3 keys or you hold, 0 keys, that is a risk that some Bitcoin people may think, you know what, that's more risk than I'm willing to take, right? So, and I think it's fair for us to give a balanced presentation. Now, I think obviously there are some great benefits here now, I believe in that product, but I also want to be clear, here are some of the risks out there. So anything else you wanted to add there around the risks?
No, I think you nailed it. It's obviously there's custodial risk, there's liquidation risk, BTC USD exchange risk. I think one of the things with the fiat monetary system is the stuff that we saw last year in March of 2020, this kind of hyper deflationary events, these risk off across every asset class, equities, Bitcoin, real estate. We saw the treasury market in March of 2020 go illiquid, no bid. This sort of stuff is a result of a hyper amount of leverage in the incumbent system, and that is going to continue just in various points, unwind in these huge cascades, and they're going to have to reinflate the system. And so if you're subject to this exchange rate risk during those periods, and you're already levered up, you're already with all of your stack already levered up to the head because you think Bitcoin's going to the moon, which it will eventually, but you're putting yourself in a huge risk there, again, to become a forced seller, which is the last thing you want. So all of these things, it's if you want to even consider it, optimally you don't want to do it with a large portion of your stack. Conservatively, I say 5% maybe. And so if you don't have a large amount of Bitcoin, like some of these strategies aren't really all that worth it.
Viable,
It's not. It's just borrow $100 of Bitcoin. It's you can do it maybe, but it's some of this stuff is just you kind of want to have a nice little stack to execute these things and really have it be viable. And really optimally, anytime you enter one of these things, it's hopefully, I think optimally Bitcoin has already drawn down 50%, right? That risk has already kind of been taken off the table a little bit. There still is obviously more downside. There's no free lunch like you highlighted, but doing this at all-time highs when everyone's euphoric and Bitcoin has already gone up by 400% in a year is maybe not the best time. And I would just say, maybe be prudent and continue to stack some sats because, again, there is no liquidation risk with Bitcoin in your cold storage. There is no counterparty risk. So, that's the important thing to continue to reiterate, as we've talked about multiple times. It's just continue to hammer that point home.
And one more risk, actually, I'm just thinking of it now, is let's say you take out a loan, you still need to be able to make interest payments on that. So as an example, if you lost your job, that could also be a problem for you too. So you should also be thinking about that too. So let's say you enter into a 3-year loan, you borrow some Bitcoin and you're trying to do this strategy. If you lost your job, as an example, like you're working in some other sector or whatever sector, or even in the Bitcoin sector, whatever, if you lost your job, then your ability to repay that loan now is at serious jeopardy, or is now jeopardized. And so that's something to also think about. So that's also another reason for people out there to be conservative in how they do this or think about these things. Although, you might be able to find ways around it. Like, let's say if the number goes up enough, well, okay, maybe you might be able to still make it work, but it's just something to think about also.
100%. Great point.
Yeah. Okay, so I think these are all really good points. I think it's been a very illuminating discussion. I think one other area I wanted to touch on with you is just kind of where we're going with this. Now, we've spoken about this idea that it's sort of foreboding the eventual crash of fiat, right? That people, and I mean, it's a global world out there, right? Like probably 45% of my listeners are in the US, but hey, there's a lot of people out there all around the world who might be doing this in their local currency. Yeah. But I'm curious what happens, because as an example, it could be that eventually credit freezes up. So it's like people want a loan, but actually banks the fiat banks can't offer that credit anymore. So I'm curious what you think, whether that is a scenario that could happen or a likely one, and how would you deal with it in that scenario? So let's say you've done this Bitcoin loan and you're trying to roll it over, but now credit is freezing up. And so now you're stuck, right?
Yeah, I think it's a really interesting kind of the convergence between the central bank fiat monetary system and this kind of emergence of the financialization of Bitcoin and more broadly like crypto markets. And I say that and a lot of people will cringe, but you're seeing kind of this rise of peer-to-peer lending. Stable coins are exploding, all of this stuff. Like, I mean, again, I'm not going to hold a significant portion of my net worth in stable coins, because essentially it's a commercial bank IOU wrapped onto a blockchain IOU, which can be frozen at any point. But what you're seeing is, with all of that aside, is that you're seeing a lot of these markets emerge, at large scale. Total stablecoin market value, I think, is well surpassed 100 billion. USDC and Tether alone are surpassed 100 billion, and you're seeing a lot of kind of other sort of kind of stablecoin protocols and all this stuff that's not Bitcoin, but you're seeing these lending markets, these peer-to-peer markets emerge, whether that's on centralized exchanges, or you're seeing these again and these protocols like in the altcoin sphere. They're like there's a lot of risk there, but you're seeing these markets emerge, and the free markets, right? So whether it's on FTX peer-to-peer, where you can take your USD liquidity, your BTC liquidity, and in a peer-to-peer fashion, in an over-collateralized fashion, lend it out to people who want margin. And so there's all these things that are arising that you have this kind of natural rate of interest. Also, you have, like we talked about earlier, you have this Bitcoin futures market. And so you're seeing in times where Bitcoin is a really, really big bull market, you're seeing basically the demand to be long Bitcoin is really, really high. And so you can just, in a completely market neutral way, you can be just short futures, long spot Bitcoin. So basically what that means is you have your Bitcoin, that's your long spot, and you sell it in the futures contract. You basically lock it in and say, I'll promise to sell this, and the counterparty does this for you again. So there is counterparty risk, but you can capture, say, 40% yields, 50% yields, and this is essentially, I think of this as an interest rate. You have, say, the Bitcoin perpetual swap, which is there's a BTC spot price, which is traded around the world. There's a spot index. The perpetual swap is a derivatives contract where there's long and shorts, and there's an equal amount of long and shorts on every derivatives exchange. Every buyer needs a seller, but there is a perp price. And so if those longs or shorts on the derivative exchange want to bid up the price of Bitcoin against the spot index, well, there's a funding rate. And so if, say, the price of Bitcoin is 60,000 today and the perpetual swaps price is 61,000, well, what you're going to see is that longs have to pay shorts an immense amount of funding, basically a notional percent of their position size every 8 hours or so. And so that in itself is a market interest rate, if you want to think of it. In the legacy world, we have like a treasury and we have a coupon yield. Well, in these Bitcoin markets, we have the BTC USD exchange rate, and the futures curve is almost this interest rate. And so I think the interesting kind of dichotomy is the central banks, the governments around the world, if they stop printing money, then everything is going to collapse. And BTC, everything else will see far like huge corrections in their dollar denominated price. But we know that with the Bitcoin protocol, proof of work mining, the difficulty adjustment, there will be basically a production cost to Bitcoin. So there is value that we know will be maintained. But regardless, they have to print. If they don't print, everything collapses. But we'll still have these native markets for this cost of capital. And so it's almost like a check on these central banks and governments. And the moment they start to print again, we'll see the exchange rate for Bitcoin and for equities and everything else rip again, and all these lending markets will be once again flush with liquidity, and we'll see you'll see this in action in March when everything crashed, and literally there was no credit available until the Fed and everyone else stepped in. Well, in the crypto markets, actually, the lending rates were basically zero or negative in the sense that they were paying you to go long Bitcoin. Everybody across the board is wiped out, and you could essentially you could go long Bitcoin on say a perpetual swaps or like all of the stable coin yields. It's like at zero. The cost of capital in these crypto markets is at zero, and so I don't know necessarily what's going to happen, but what I do know when I'm saying all of this is that there is a check on the centralized kind of commercial bank fractional reserve credit extension that we've seen in the past. And it's these free and open, wild west. And let me be clear, it is the Wild West in what's happening. Billions of dollars every second of the day are being thrown around, being borrowed, being lent out, being over collateralized. It's really fascinating to watch, but there is this parallel system being built out. And so, what will emerge? What will will there be a Bitcoin native DeFi liquidity pool that's secure protocol in the future? I mean, I hope so, and I'm really excited to see what's built. But I do know that it's really exciting, and there is kind of this kind of native cost of capital in Bitcoin that is variable, but that is completely out of the realm of central planned kind of central bank monetary systems.
Yeah, it's really fascinating to think about. And I can tell you've obviously put a lot of time into researching and thinking about this. And even for me, it occupies a lot of my time as well. I'm thinking about, okay, it's essentially using the fiat system against itself in like this kind of crazy judo move where Bitcoin hodlers are essentially using the system against itself so that they can keep on stacking, or they can keep on Bitcoin mining, or they can live off their stack without spending their sats. And so it's just a really crazy interaction of all these different fields in terms of accounting, tax, economics, finance, global macro, maybe throw in a little bit of on-chain analytics and looking at what the exchange derivative rates are and looking at what the bank, like fiat bank funding rates are. It's just this crazy mishmash of fields, and I think it's very intellectually very stimulating to sort of think about. So very interesting stuff for me. But I think it's probably about time to wrap up here. We normally keep it about an hour on my show. So Dylan, where can people find you online, and tell people where they can find the deep dive also?
Yeah, so you can just find me on Twitter. I spend a lot of time there just kind of interacting with everybody and throwing around a lot of these ideas. Like I said in the introduction, I'm working on the deep dive with Bitcoin Magazine, so we kind of cover a lot of the on-chain stuff, derivative stuff, and again, it's kind of outlined with this macro thesis, this hyper Bitcoinization thesis that it's the best money the world has ever seen, and we've talked about all this kind of extravagant lending ideas and borrowing ideas today, but just to make it clear, and in the deep dive, I say this probably every day. We're not getting trading signals. That's the first thing. But the second thing is that, you can't lose by just stacking sats and having a low time preference and just riding the wave and just stay humble, stack sats. Shout out Matt Odell. A lot of this stuff, it's interesting to kind of to think about, and to execute is exciting, and there is some risk there, and if you make it out, then you basically outperform Bitcoin, which is very hard, but you can't lose with just hanging back and doing what we all know is the best. So Stephan, I really appreciate you having me on. This is kind of a it's a really fun, wide ranging topic on a lot of stuff that I don't cover too often on podcasts. So it was a nice change of pace, and I'm looking forward to getting this one and listening to it.
Fantastic. Dylan, well, thank you for joining me. I really enjoyed chatting with you.
Appreciate it.